we're starting now. Can we have a round of applause for Zach and Matt from Wintermute? Thank you so much.
Yeah, so this first presentation will be like a quick introduction and overview of Wintermute. Who here has heard of Wintermute before? First time? Okay, cool. So maybe we can skip this. But yeah, basic stuff established in 2017. Crypto native algorithmic high frequency trading firm, whatever that means. Basically, anywhere there's liquidity with digital assets, Binance, KuCoin, Coinbase, DeFi protocols, we trade at. Some places we just take liquidity, other places we also put orders into the market. Excuse me. Yeah, growing team, 125 staff members, hiring somewhat on and off at the moment, but I'll let Matt speak more to that later on. Yep, we do OTC, liquidity provision, ventures. Okay, let's go to the other presentation. All right, so market making on chain. Really, it should be called like trading on chain. And I guess the core categories that Wintermute and like most other market makers that also trade on chain are involved in are like AMMs. And within AMMs, we have this thing called SexDex arbitrage, which is arbitraging prices between centralized exchanges and decentralized exchanges. And I guess the core driver behind that is that on most blockchains, state is not continuously updated. It's a discrete update every time there's a new block. So if your block time is like 10 seconds, then your prices only change every 10 seconds. And so you can imagine there could be some like dislocation in prices compared to centralized exchanges, which are constantly updated. Liquidations, this is more maybe exciting because when they hit big, and you can make like a huge amount of P&L in just like one day. I'll share like a chart later on which kind of depicts this. And RFQ, this is like a pretty traditional thing. Anybody familiar with what RFQ is perhaps already? Okay, somewhat. So RFQ stands for request for quotes. It's similar to OTC. OTC is over the counter. Instead of going to like a centralized exchange, you go directly to a market maker, you tell them what you want, and then they give you a quote. And you can decide whether the quote is good or not, and then execute something on it. So I'll get to that towards the end and like talk more about Last Look, some of the controversies behind Last Look, and then also talk about RFQM, the RFQT, which is more of a DeFi on-chain specific thing, which you don't really see too much in like traditional models. Okay, so AMMs, just to give like a brief, I guess, backstory of what an AMM is. Everything is like a smart contract. Has anybody interacted with an AMM before or like made a transaction on chain, just so I have like an idea of what I'm like working with? Okay, sure. So I can't like explain everything down to like the smart contract level. I'm just gonna have to assume some things. So yeah, an AMM is a smart contract, which is just some immutable code, which does something that you want it to do. And what an AMM does is it stores this model, this pricing curve, which is just a constant product function, xy equals k, and like it allows you to trade against its pool. And all the pool is, it's holding two tokens. You can imagine some ETH and some USDC. And if you want to buy ETH, you give the pool USDC, and the pool checks that it respects this curve. So if you want this much of USDC, you need to give this much of ETH, or vice versa. And if it doesn't, then the pool like reverts, and your transaction doesn't go through. And so that's like the underlying price model of an AMM. It's very simple. To determine the price of an AMM, you just divide the reserves. So it will be the reserves of token A divided by the reserves of token B. Pretty straightforward. And like AMM only works if there's liquidity providers. And a liquidity provider is anybody who wants to put funds into the pool. They have to put both tokens into the pool, and they basically determine the starting price. and the incentive is that they can earn fees from anywhere from 30 to 100 bips. They do have some trade-offs. For example, they have to take on some positional P&L risk. If the price of one of the tokens appreciates significantly against the other, maybe you're better off just holding the two tokens, and this is often referred to as impermanent loss. It's the loss that's not realized, but then at the moment you move your funds, you realize, oh, okay, maybe I was better off just holding these tokens instead of actually providing liquidity. So that model that I just described is the basic AMM model, and actually it's not very good. So if you go back to this this pricing model, if you deposit like $100 worth of ETH and $100 worth of USDC, that liquidity is basically provided across the entire curve. So from the price of 0 all the way to infinity. And so the market is not very deep. And if you imagine two tokens that are like correlated in price, let's say like two stable coins, USDC and USDT. These tokens, the price range typically you'd expect is anywhere from like 0.99 to like 1.01. And that's pretty like optimistic. And so if like, let's say this price point right here is like 0.99, 1.01, all of this part of the curve is kind of wasted, and like that liquidity will never really be used. So you could actually improve that by using concentrated liquidity. And what concentrated liquidity does is a liquidity provider now comes to the pool and says, okay, I want to provide liquidity, but I'm only going to provide liquidity in this particular price range. And essentially what that does is it creates deeper markets. There's less price impact when you trade. And yeah, usually you see this with correlated assets and like assets that are expected to like be within a particular price range. And an example of this is Uniswap V3. They were kind of like the ones who made this mainstream. But yeah, so this is the uniform distribution of the initial V2 model. And then you can see that this is just a particular tick that you want to supply liquidity across. And then this is an aggregation of all of the particular ticks. So if you imagine that this is like USDT against USDC, and this is the price of like 0.99 to 1.01, then you can see that the market is the deepest here. And I guess the point is that you, as a liquidity provider, can maximize the trading fees from that particular tick. Okay, so what can we do with AMMs? So there's two things you could do with AMMs. You can provide liquidity or you can take liquidity. And this atomic arbitrage is an example of like liquidity takers. So what is an atomic arbitrage? Like similar to databases, you have atomic transactions, which are transactions that either execute or revert. And so what you can say is, okay, I have a profitable opportunity between multiple pools that, okay, let's say there's an ETH USDC pool, and then there's a USDC USDT pool, and then there's a USDT ETH pool. And so what you can do is you can create like a profitable cycle going from one pool to another to another. And so the necessary condition for this is that the prices need to be unbalanced between the different dexes, decentralized exchanges. And so I think there's like an example here where, yeah, you have ETH USDC on DEX 1, and then you can basically buy USDC on the second DEX and arbitrage the different prices. I also have an example transaction here, which I think maybe won't be helpful just because, let's see. Okay, so this atomic arbitrage is between this token called DEX tools over here. How easy is it to see this at the back? Not quite. So okay, okay. I guess we will skip this for now. If I can think of a better way to present this. Okay, so how does an atomic arbitrage work? So you need some state firstly to begin with. The state you need is the prices of all of the pools that you want to include in your calculation for like an arbitrage. And so you can imagine you're indexing any pool on like a decentralized exchange. You take the ETH USDC pool, you take the USDT USDT pool, basically anywhere there's liquidity you want to index. And then when you index this, you can kind of like lay this out in a graph data structure. And you can say, okay, so if there's a pool between two assets, an asset is your vertex in this case, and a pool is essentially an edge, and the weight of the pool is the price of the exchange rate or the price of the pool. And this is like a pretty standard model. It's even used in like FX trading, and I guess the algorithm you can use to calculate like a profitable arbitrage is the Bellman-Ford algorithm. Has anybody heard of this algorithm, or is this like new? Okay, nice. So yeah, I probably won't explain exactly how the algorithm works, unless you guys want me to. Are you interested in how this algorithm works to find a negative cycle? No? Okay, I guess not. But yeah, so the structure of this is you use logarithms as the price, because the algorithm basically works by calculating the minimum sum of all of the distances, and like a profitable arbitrage would be the multiplication of all of the exchange rates. So if you imagine one exchange rate is like 1 and the other one is like 1.2, you're multiplying them to work out your net like P&L. But that doesn't really work if you're minimizing distance. So you can transform that into a logarithm where the addition or subtraction is multiplication. Does that make sense? Okay, nice. And then the other point is that Bellman-Ford only really works to like minimize problems, and you're working out like a profitable cycle is actually like a maximization problem. So again, you can like use the negative of the logarithm to basically convert this into a problem that Bellman-Ford can handle. So the largest product of exchange rates is equivalent to the smaller sum of negative logs. So you're basically flipping the problem on its head. It still means the same thing, but it's just in a format where this algorithm and other like graph algorithms work. But yeah, so it's kind of a naive approach to begin with, because let's say there's like 100 different arbitrage opportunities that are available. How do you determine which one to take? It's like it's typically Pareto distributed, where the like 1 or 2 arbitrages make up like 80% of the P&L. So you want to make sure that you execute those opportunities, otherwise you're probably going to lose money. And that's kind of one of the like drawbacks to Bellman-Ford, like in its vanilla form. So you have to kind of like be creative and figure out ways to kind of tackle this problem. And one way to do this is a random node removal after finding a successful cycle. So let's say you run the algorithm once and then you find a cycle. Then what you can do is you can randomly delete one of the nodes within this cycle and then run it again and like iterate on this process to find other potentially profitable cycles. It's still not perfect, but it's definitely better than the base case where you kind of might not just find the most profitable cycle on the first try. The other issue is there's an exponential increase in cycles as you add more nodes. So it's a directed graph, and the maximum, I guess, capacity of a directed graph is n times n minus 1 if like everything shares a connection. And if you add one additional node, then you kind of exponentially increase the number of possible cycles. So then you have to be smart with like what cycles do you, what like tools do you want to add, and like simple heuristics that you can follow is like, does the pool have liquidity? Have there been trades in the past like week where if there probably isn't much volume, then there probably won't be a need for you to find like an arbitrage, because an arbitrage is derived from price differences, and if there's no trading, then probably won't be any price like differences. And yeah, the final point is that Bellman-Ford returns a percentage of profit, not absolute terms. So your result from running this algorithm would be like 1.1, for instance, which denotes that you'll make like 10% profit on like a trade. But actually, that's not true, because your sizing of the trade is determined by the liquidity in the pool. If a pool is very illiquid, and you try to hammer like a huge size, then you're going to eat a lot of your credits are going to be eaten by slippage and price impact, and so you kind of have to factor that in as well. So I wanted to just give a quick overview of like a naive approach. There's a lot of papers out there that kind of explain more optimized versions of this, and like I can link to those as well if you guys are interested. And actually, quickly, the last point is that gas costs. So on a blockchain, you have transaction gas costs, and these aren't fixed. Usually, it's determined by what action you're doing. Like if you're making a trade in like a pool, then that's going to have like some cost X. If you're doing something like liquidation, it's going to have some cost Y. And your cost is also varied, and it's based on gas price. gas price is also then dependent of how much activity there is on this particular network. If it's a very busy period, and typically during volatile periods, you can imagine it will be very busy. That's like a fair assumption to make. It's not like pretty wild. Then your gas costs are also very, very varied. And also, like, maybe your gas cost, it depends on the trade size. So you have like the circular problem where you don't really have like a clear starting point. So yeah, it's not great as a base solution, but it's a naive one. And tomorrow, if you wanted to implement this, you probably lose money. But maybe you can figure it out. But atomic arbitrages sound nice, but there's no free lunch. If there was, it would be like eaten away by somebody else already. If you find like a atomic arbitrage, you're bidding away 95 to 99% of your capital, and purely because these opportunities are risk-free. You don't need any capital to execute them. If you don't make money, your transaction reverts. So the only thing you're paying is like some gas cost. So yeah, and like the best teams are using GPUs to basically do a bunch of parallel computation. And if you're running this on your MacBook Pro, you're probably not going to compete. And yeah, they have like highly optimized algorithms and infrastructure. And like the algorithm that I shared earlier was just like a simple example. So I had this interesting example to share. It's actually a recent trade that happened like maybe 2-3 weeks ago, and it basically broke a record. And the record that it broke is that this trade was routed via 44 pools, and there was 24 distinct tokens traded. And so you can imagine how like complicated this graph would look, and like just finding this opportunity is like, it's pretty impressive in its own. I'm not gonna like go too much into the detail. I just want to show you what the graph structure looks like, just so you have an idea of like the complexity of this and like I guess like how impressive it is. Internet. So yeah. Okay, so I'm still scrolling and I haven't even reached the top. But this is basically all of the trades that they made within this one single transaction. So they're routing via these things are all pools, and they're sending like Ethereum to these pools, and in exchange they're getting some other tokens, which they're then sending to other pools for other tokens, and so on and so forth. And like this is the scope. So yeah, I'm not going to bore you with that, but very impressive. Okay, so I wanted to make a quick aside on like sandwiching, which is pretty related to atomic arbitrage. They're like similar families in this. And so an atomic arbitrage only depends on on-chain state. And for this state to change, you need some user to take an action. If nobody's making trades, then the state will stay stagnant and there's no opportunity. But actually, with the nature of all blockchains, or most blockchains, they have a public mempool. This isn't the model for every chain. Some chains, they don't have a mempool, so you can't really like listen to this mempool and find transactions before they're executed and included on chain. An example of this would be Solana, where you're sending transactions directly to like the equivalent of a miner, who's the block builder. But yeah, so if you're able to identify a transaction in which you could basically make an arbitrage out of, then you're better off essentially sandwiching the transaction. And what that means is you're front running the user. So like, let's say I'm an innocent user. I come in and I say, okay, look, I want to sell 100,000 worth of ETH for USDC. Then like I send it to the public mempool. It's there. I have a diagram here to quickly, actually I don't, I lied, sorry. I had a diagram to depict the mempool, but yeah, okay, I guess we're gonna have to go with words for now. So yeah, I send a transaction to the mempool and I say, okay, I want to sell 100K worth of USDC, ETH for USDC. Then somebody's monitoring this mempool, they see my transaction and they notice that they're able to sell before I sell. And so then once I sell, they can then buy back cheaper. And they basically take the difference, and I'm the person that basically funds their P&L. Anything that I lose, they gain. It's a zero-sum game. And basically the deriving factor of sandwiching is how I set my slippage. And so slippage is the tolerance, is my tolerance of price impact. It's not necessarily price impact because it depends on other people trading. And like slippage also exists in like limit order books as well. Like let's say I go to Binance and I want to make the same trade, and like at that particular point in time, let's say the mid price is like 1K for ETH, and then like somebody comes in just before me, they have better infrastructure, lower latency, and they make a huge sell order. Then the mid price will like necessarily like be lower, and then I'll eat some slippage just because they were ahead of me. So slippage is not like a new concept, and it's pretty important as a trader on chain to set like a reasonable slippage limit, because let's say you set 10% slippage and you're sending this to the public mempool, then somebody is able to come in and basically give you a 10% worse of price, because by setting a 10% slippage, you're saying, okay, I'm okay with eating this, and yeah, so that's basically how sandwiches work. They require bundles. I'm probably not going to go too much into what a bundle is, but essentially it's a group of transactions. So usually you're sending one transaction, but a bundle lets you atomically send 3 or 4 or n transactions. And I guess the improvement is on that is you can make more complicated actions. And this is facilitated by out-of-protocol infrastructure, MEV Boost, for instance, if anybody's familiar. And then the final point is that sandwiching in general is not ethical. And also, we don't do it at Wintermute. Okay, so yeah, now probably the more important of the arbitrages, sex-dex arbitrage. And so what I described with atomic arbitrage, which only depended on on-chain state, you can do the same, but by using off-chain states. So centralized exchanges in general are much more liquid and usually price leaders when compared to like decentralized exchanges for majority of the tokens. So what you can see here, kind of, this is like an action that's driven by a user. Somebody comes in, they make a trade on Uniswap, they push the price up, Binance price doesn't change, and so there's room for somebody to bring the Uniswap price back down to like the Binance price. And then like in general, it's less competitive, and it's less competitive because it's riskier. The reason why it's riskier is, one, because it's not atomic. So all a sex-dex arbitrage is you go to a pool, you give it some like ETH, and in exchange you get some USDC. You're not closing the arbitrage in that single transaction. It requires a hedging leg, and this hedging leg you can do on a centralized exchange. The hedge could be just as simple as selling an asset, but to sell an asset, you would have inventory on both sides. Again, which is like more risk because you're exposed to price changes now. You're not delta neutral, for instance. You could also sell like perps, but like it's more complicated than just like selling. Does anybody have any questions so far? Am I going too quickly? Okay, cool. So yeah, so this is some old data from like 2023, which kind of shows the difference in opportunity size. And also you can see that the cost is significantly less for arbitrage. For CeFi DeFi arbitrage, you can't see this over here too well. I think something's like covering it, but it says CeFi DeFi arbitrage, and so you can see usually atomic arbitrages are bidding like 95, 100% of their P&L, and CeFi DeFi is way less competitive. On the lower end, it's usually bigger size. So like you can imagine like few million clips, you're not going to be bidding too much just because as size increases, competition increases. But yeah, I'd say these numbers are not like representative of all of the players within the space. It's kind of difficult to get that data. You don't really see like the off-chain leg, which is kind of difficult to get if you're not the person making these trades. But everything on-chain is public, and yeah. Okay. All right, so that was like a quick overview of like liquidation, AMM trading. Now we'll move on to liquidations. Just trying to get an idea. Okay, sure. So yeah, anybody familiar with like liquidations in general? It doesn't have to be related to like crypto markets, but just like as a financial concept. Yep. Okay, good. So yeah, like borrowing and lending is like an important part of DeFi, but it's like you're not borrowing as you would go to your like local bank and say, I need some funds to cover some costs for some operational expenses or whatever, just to live like day to day. It's more for like, I guess, making more complex financial expressions on the market. And what I mean by that is it's ideal for leverage trading and also long and short trades. If you have like a 100K in ETH, you can go up and like triple, 3x leverage your ETH if you believe that the ETH price is going up. And the only way to do that is by borrowing, and you borrow against your ETH collateral. And this is usually called like looping when it's the same asset. But yeah, on DeFi, borrowing requires over collateralization. And so for every $1 you borrow, you have to give $1.5. And the main reason for this is because if it was under collateralized, you have no way to determine whether I'm like a credible borrower. Like for instance, everything on blockchains is like some binary address, right? I can go to a protocol with a fresh address and say, hey, I want to borrow like 100K of ETH and I'm only going to give you 20K of collateral, but just trust me, I'll pay it back. And of course, nothing really like constrains me to paying it back. And that's why we over collateralize things. That way you have an incentive to pay it back. Because if you don't pay it back, then you're going to lose more than, usually you're going to lose more than what you gain. And liquidations, they exist to protect lenders from bad debt exposure. And so there's an example there. If you borrow 100K in USDC and you supply 150K in BTC as collateral, if the Bitcoin price dumps sufficiently such that your collateral is now worth less than 100K, then I, as the lender, will take on the loss. And this is bad. You don't want to incentivize. You don't want to like discourage lenders from providing liquidity, because that's what drives your protocol and that's what drives like borrowing. Without liquidity, you don't have borrowers. They have higher interest rates. So yeah, it's not great. And yeah, this is assuming that the USDC value remains. And yeah, so liquidators are not doing this work for free. They're incentivized with some bonus. And this bonus is coming from your over-collateralization. So you can see this is like a 1.5x over-collateralization. If for every dollar, you need to supply $1.5 of collateral. And as a liquidator, I might be incentivized with 10% of that. So if I liquidate you, I might be getting 15 cents on every dollar. So yeah, so this is a simple query that I made to kind of like show the volatility and variance in liquidations. And it would have been good if I plotted like some BTC USDC price chart, so you can kind of get an idea of when the market tanks. There's a lot of liquidations, and it just happened to be that on February 2nd, the market dumped. And so there was a huge amount of liquidations. There was like almost 200 mil in liquidations on the day. But typically it's maybe like 45, 50 mil. But like I said, you're getting like a 10% bonus usually on liquidations, anywhere from 5 to 10%. And so the opportunity size is pretty big. Yeah, so actually I have an example here. Before we get to the example, an important concept is the health factor. And so the health factor determines how healthy your loan is. And essentially, if it's 1 or below, it means, or if it's less than 1, it means you could be liquidated. If it's 1, well, you better top up your collateral, otherwise you might lose some money. So yeah, so for this example, ETH USDC is $2,000. We assume 1 USDC is $1. Actually, another thing to mention is the loan to value. So this term on the top right, LI, is the loan to value for your collateral assets. And what the loan to value is, or what it represents, is essentially like how dangerous or risky or like volatile your collateral asset is. If you have like a stable coin, for instance, like USDC, which is not very volatile, usually remains around that $1 range, then the LTV will be higher. If it's something like ETH, which is relatively more volatile, then this LTV would be lower. And again, this is the lower the LTV, the more you need to over collateralize, and the more protection there is to lenders. So yeah, this health factor is just taking the sum of all of your collateral assets, valued in US dollars, multiplied by the health factor for each collateral assets, divided by the sum of all of your borrowing. And if this is above 1, you're fine. If this is less than 1, you can be liquidated. And so for this example, the liquidation bonus for ETH is 5%. Let's say you supply 500 ETH, and then you take out, which is 1 million USD in this example, and then you take out 750K of USDC. If you compute the health factor that I presented up there, then the health factor you get is 1.067. And then you can derive the liquidation price if you set the health factor to 1, less than or equal to 1. And so if there's an Oracle update that pushes the health factor less than this, then anybody can liquidate you and earn 50K in bonus. But in general, liquidations are very competitive. And so this is going to push your margins down. And lending protocols, they have measures to protect borrowers as well. For example, they limit the maximum size you can liquidate on a position. Like some protocols, they choose to limit this to 50%. And yeah, essentially that means you as a borrower lose less money if you get liquidated. But it's not true for all protocols. So yeah, I mentioned oracles in the previous slide. I wanted to give a brief comment on oracles and why we need them on chain and blockchains and DeFi. So a blockchain in and of itself is a very simple state machine which doesn't know anything about the real world. It only knows stuff that people like tell it about. If nobody tells it the price of BTC from like Binance or whatever, it won't know the price of BTC. And so they relay off-chain information on-chain, and some examples of like the most popular oracles are like Chainlink, Pith, if anybody's heard of them. And so we need them for pricing. That's like the most obvious use case. Now, I said that there are liquidity pools on chain, which I didn't mention anything about oracles because actually the price on a Uniswap pool, for instance, is just the fraction of the reserves. So it's not necessarily true to say that you need off-chain information to derive prices on-chain, but it is true that if you're using on-chain information, then you're basically you're very I guess you can be exploited in a way by like price manipulation is easy on chain. And so, yeah, so without oracles, any protocols that need accurate pricing for lending and borrowing purposes is like the easiest use case. If you're borrowing assets on Aave or like a lending protocol, then you need to know the price. And to know the price, they use oracles. And yeah, you can rely on AMMs, but yeah, like I said, this is very easily manipulatable, and especially with flash loans. And now, flash loans is an interesting concept that I'll touch on a bit later, and then we could come back to this and maybe it will make more sense. But yeah, Oracle prices, they're transactions just like anything on a blockchain, and they're pushed on-chain by operators. And like, I guess you might be wondering, like, where are the guarantees that this update is real? And like, you know, if I'm an operator, you can imagine a scenario where like there's a strategy, I can update like a really bad price, and then everything that uses this price, I can then like manipulate and exploit. But you typically, Oracle networks, they use like a distributed Oracle network. And what this is Chainlink, one of the Oracle providers I mentioned earlier, will have like 200, 300 people running a particular node, like software that they write. And this software is responsible to push prices on chain. And they economically incentivize these people that are running these nodes. And so there are still some trust assumptions. You assume typically that like 2/3 of this particular network acts truthfully. And yeah, I guess you just kind of have to live with that. Yeah, you can obviously monitor updates yourself and decide whether there's a risky update to remove positions and whatnot. So how do liquidations work? Again, you need to index some data. And usually with liquidations, this is the biggest pain when you're integrating and you're running some strategies. You need to keep track of every position. And of course, like interest is a factor of positions of people that borrow. And so interest accrues every block. So you need to keep up to date with interest for like 50,000 positions every block. And so you can imagine it gets like very inefficient if you're not smart about how you index these positions. So that's like there's some alpha and an edge in indexing in a good way. And then you only really care about a small subset of positions. Typically positions that have a health factor less than like 1.2. There's no point in monitoring a position that has a health factor of like 3 or 4 because the liquidation price is very, very low relative to the current market prices. And if there's like a health factor, so you're monitoring these positions, and then you're also monitoring Oracle updates. If there's an update that pushes the health factor less than 1, then you attempt to liquidate the user. And then like, of course, you need inventory to liquidate somebody. You're not going to liquidate somebody for free or with no assets or whatever. You need to repay their debt to actually get their collateral and then take the bonus. So you have a few options to get this inventory. You can get it atomically, which kind of goes back to the earlier point about atomic arbitrage. And the way to do this atomically is you need to get a flash loan, which I maybe just talk about now, and then I'll go back to this slide. Yeah, so a flash loan is like a very primitive concept in like DeFi, and it's like a pretty innovative, or at least it was innovative at this time. Now it's like a pretty normal thing that people are used to. And so imagine you go to a liquidity pool. It could be like an AMM pool that we mentioned earlier. It could be a lending protocol that has like a large amount of funds. And you say, I need a lot of money to execute an opportunity. Let's say hypothetically there's a position that's almost underwater, and if you have 10 million from a flash loan, you can then go and liquidate this position. Then you say, okay, I found a very profitable opportunity, and it will make 10% on my capital, my initial capital, but I don't have the inventory for this. I promise to pay it back to you after I capture the opportunity. And so then you even can like sweeten the deal by saying, okay, I'll pay you a 1% fee. And you won't find this anywhere outside of a blockchain. The smart contracts and like the atomicity of transactions ensure that you have to adhere to the contract saying, okay, by the end of the transaction, I'll return your funds. If this isn't the case, your transaction will be reverted, and then the state of the blockchain will be reverted back to before your transaction. So yeah, any questions on flash loans? I think it's a pretty important concept to understand. Yep. Yeah. No, so, okay, imagine a SexTex arbitrage and you take a flash loan. Let's say the ETH/USDC price is out of line, and you take a flash loan to go then and like buy some ETH/USDC. But you also need to repay it. And if your hedging leg is on a centralized exchange, which is off-chain, you need to go and do some actions on the centralized exchange and then return the funds back to the flash loan. But this doesn't happen in a single transaction. You have to go off the chain. Yeah, so smart contracts only operate on the chain that they live on. So there's many chains out there. Let's say we'll talk about Ethereum, for example, for now, and there's a smart contract on Ethereum. This smart contract doesn't know anything about smart contracts outside of the chain. Yeah. But yeah, so atomic arbitrages do use flash loans, though, to operate. Remember I said it was risk-free. They don't have any inventory. They always take a flash loan from when they find an opportunity. Yeah, so this is like a diagram to depict a flash loan to maybe make it clearer. So yeah, you take a loan from like a flash loan provider. Aave, the bottom logo is a lending protocol. Uniswap, the top logo is the AMM provider or AMM protocol. And so you take the flash loan, and then you invoke some function on your contract. It could be like liquidating somebody. It could be doing an atomic arbitrage. It could be whatever it is. Then you repay the loan back, and then these providers and the smart contracts will check the state. This is a very important point. Without this, it doesn't work. And they basically enforce that the funds have been returned, and if there's any fee or whatever, then the fee has also been paid. Okay, now moving on to RFQs. All right. So it's pretty standard. It's like identical to traditional RFQ. I'm not sure how many people know about traditional RFQ, so like I'll give a brief run through of what it looks like anyway. So yeah, so you have a Clearbank, which is just an example placeholder for now. And I don't know how well you can see this at the back, but essentially it's just like showing the interaction between somebody who pings a market maker or like a bank or a broker or whatever for an RFQ, a request for quote. And so you make a post request to their servers and say, hey, give me a quote. I want a quote for ETH/USDC. I plan to sell like 1,000 ETH. I want to know how much USDC you're going to charge me. And then the bank or the market maker returns with a response saying, okay, hey, here's your quote. You can decide whether it makes sense for you, if it's a good price for you, it's up to you. And then if you think that, okay, this is actually a good price, you can then go and execute this quote. But execute with, it doesn't actually execute, because at the end of the day, it's the maker that decides to actually execute this transaction. You can see towards the bottom, they execute the transaction and then they notify the person who requested to begin with. And so why does RFQ exist? Why not just go to a limit order book and just go and smash the book, or like put a limit order in and yeah, trade it that way? Well, it's there to minimize like price impact. It's a similar reason why you might want to do OTC, over the counter. You avoid putting your order into the market and like leaking some information. Let's say you're like a hedge fund and you have a particular view about the market and you think that, okay, I think the interest rates will be lower after the FOMC makes an announcement, and I want to like put on a huge size. Then you don't really want to go to a limit order book. You want to go through RFQ, OTC, or direct to a market maker. And you could just use OTC, like I mentioned, but the nice thing about RFQ is, as you can see, these are like post requests, these are like HTTP requests. You can interact programmatically. And so what that means is it's easy for you to go and ping like 10 different market makers, get a quote from each of these ones, and then like split your size across all of these different market makers. And therefore you're improving your price. With OTC, it's like it's quite literally like a chat that you have with a market maker, and you're basically like negotiating a price, or they're giving you their bid and ask. And like it's difficult to basically aggregate a bunch of different OTC quotes because they don't last very long. So you have to be quick. And that's kind of like the main use case for RFQ. Okay, last look. This is probably one of the more interesting things about RFQ. So in the previous diagram, you can see that it's the maker that executes the trade. You as the user, you have the optionality over here to decide whether you, like in between this and this, you have the optionality to decide whether the quote makes sense. Then you tell the market maker, okay, I want to execute this quote. Then the market maker actually goes and executes your trade. And so with this, the market maker has like a free option. So a market maker, their quote is only like, it becomes stale after like a few milliseconds or like a few seconds, depending on which markets you're in. And so if I give you a quote and you like sit on this quote for like, let's say 10 seconds, it could be that the market moved like significantly against my quote. And actually, like if I execute this quote, I'm probably going to lose money. And so that's basically why this free option exists. It basically is a protection mechanism against like stale quotes. And last look though, I mentioned there's this asymmetry in the sense where like if a quote moves against you, you don't want to execute it. But if a quote moves if a quote moves like with you, or like market doesn't really move much in between the time the user gets the quote and executes it back to me, then okay, wait, let's go back to this diagram. So in between this time and this time, you as the user, you have chance to think about the quote and decide whether you want to execute it. But let's say this is like 2 seconds just for the sake of argument. Within this 2 seconds, the market could have moved and probably did move. And so after you return your intention to execute the quote, the maker gets the last look on it and says, okay, I don't really want to execute this because I'll be adversely selected. Market moved against me. You were too late. You were too slow. Request another quote. I'll give you more updated prices. Yeah. Any questions on that? Yep. I mean, there's nothing stopping you to do that. I mean, there's probably some like compliance and regulation things. Like, for instance, let's say Brevin Howard comes to you and says, okay, I want to do OTC or like RFQ for like a pretty big size. You probably know that there's like some signal that they have that you don't have because you're just a market maker. You don't really have any views on the prices or whatever. Then like, you could do that. There's nothing stopping you. But I guess that's a question for like the legal department and the compliance department. But yeah, actually funny you mentioned that because it's not really a free option. And the point is that Barclays was like allegedly like notorious for taking full advantage of the last look. And so much so that actually they faced a lawsuit back in 2015, and the settlement was 150 million, which is just like a penny for Barclays, but it's still pretty funny. So I think this chart depicts pretty well what I meant by when the market moves against you. On the x-axis, we have milliseconds, 100 milliseconds, 200 milliseconds. And on the y-axis, we have your credit. And the credit is in bips. And essentially, it's how much you would be making from a trade. So let's say 100 seconds in. So you make a quote at t equals 0. And 100 milliseconds in, the counterparty returns to you that, hey, I want to execute the quotes. Then your credit decreases. But you can see that there's like some huge adverse selection. And usually this is probably other market makers that are like trying to adversely select against you because they have like better latency, they have a better pricing signal. And yeah, you can see like -5 bips in like less than 10 milliseconds. Again, so this is on the same case where there's like the client types of like hedge funds and brokers, the guys with the signal and the guys who maybe can adverse select against market makers. You can see they make up the majority of the total rejects, which kind of makes sense. And then I guess like the final point to touch on like RFQM and RFQT. So this isn't really something typically you see in like the traditional markets. Usually in traditional markets, it's the maker that executes the quote. But on DeFi, we have RFQM and RFQT. And essentially the last letter denotes who executes the trade. So in RFQM, the maker executes the trade, and in RFQT, it's a taker. And so it's differing to the previous model where the maker always executes the trade. And why would you want to have RFQT as a maker when you know you have that asymmetric, like the advantage when you're the person that's executing it? Well, actually, it's because in DeFi, there's this like notion of like aggregating liquidity. Like maybe you've heard of like these money Legos, and like you can combine a bunch of different liquidity sources, and you can basically like, let's say you want to make a huge market order on DeFi of like 10 mil ETH for USDC, then you're probably better off like splitting that into a bunch of different like venues, and like maybe you want to tap on private market maker like Wintermute, and the counterparties that are like pinging us for quotes in this case are the solvers, is the people that are coming up with this solution to optimize the execution quality of your trade. But as I mentioned, when you have the asymmetric information as a maker, but you lose that in RFQT. And you have to be careful because now the solvers, they can basically pick off your stale quotes given sufficient expiry times. And I previously mentioned that like expiry times are typically determined by block time, which is how frequent a block is how frequent a block is created. And on Ethereum, for example, on mainnet, this is 12 seconds. And so you can imagine somebody comes to us, pings us for a quote, we return it to them. They have 12 seconds from now until when they have to execute it to decide, maybe I won't execute it. And so it's very easy to like, you can run a simple script which like listens to the Binance mid price and pings Wintermute for a quote. This is probably some alpha, maybe you want to make a note of it and make some money. But yeah, so you compare the two prices, and if any time the Binance mid is like better than the Wintermute quote, then you can adversely select against Wintermute, hedge some funds on Binance, make some risk-free profits. But yeah, so I mean, there are some mechanisms to protect makers against this. You know, there's probably like some blacklisters, but on a blockchain where you don't really have information about a new EOA, for example, like a new address, it's difficult to like have some kind of like credibility on a particular address. I think that's the end. Yeah, that's the end of the presentation. Is there any questions, anything you want me to talk about, any topic? Somebody actually asked me to talk about, sorry, I'll come to you in a sec. Somebody asked me to talk about block building. Is anybody familiar with what block building is on blockchains? You're familiar? Okay, so I probably will like avoid talking about that because it's quite like a niche topic, but it's like a decent part of like Wintermute's DeFi business. But yeah, any other topics anybody wants me to talk about? Any questions? I'd be happy to take them. Yeah, sure. We'll go with you first. If you asked me like 3 years ago, when I was like looking at atomic arbitrage just for myself, I would say yes. But now it's been commoditized. There's like pretty big players like Wintermute, other competitors. I mean, Jump do some stuff. Jane Street used to do some stuff. So it's really commoditized. But the big players only care about where the most money is. There are chains out there where it's too small for a big player to integrate. And you can go out and go and corner that market and make some decent money from it. And I know some people personally that do this. They run like these strategies that I described just on smaller chains, which is not interesting enough for the big players to integrate. So it's basically like the cost of integration doesn't make sense for them from the opportunity that's available. Yeah, go ahead again. Yeah. So when you say find these strategies, do you mean like atomic arbitrage, like finding it, or? Okay, so I think I have like a lot of sources that I haven't included on the slide that I can share, and like maybe the organizer can share, but like plenty of papers that describe how to implement like a very optimized version of Bellman Ford, which is adapted to this particular use case that I described. So you can go and read that paper, maybe try to implement this yourself, and then go and buy like a AWS box and just run something. I think the best way to like try to make money is to actually like put something into practice and not just sit there and like think about the theory, but actually like just write something and get it out to production and see how it does and iterate on it. That'll be like my advice. And my advice would also be to start with atomic arbitrage. It's the one that has the least barriers to entry. But like I said, the profit margins are very compressed, but you can easily go and find like a less active chain and like go and corner that market. Any other questions? Yep. No, yeah, so sure. I'd say in general, like the top 100 coins, Wintermute most likely trades. More recently, there have been like, I guess like the meme coin narrative and the hype around meme coins, which in like my opinion, in the limit, like every meme coin is worth $0. So it would have to take a lot for Wintermute to like trade these meme coins. But yeah, like top 100 coins is a pretty good like benchmark, I'd say. But actually, like on the topic of meme coins, and since I like finished the slide early, I'll actually like give a quick. What's the time? What time do we have to be done with this? Anybody can tell me? Sure. Okay. Sure. So I didn't mention any like long tail opportunities on this. All of these opportunities are the ones that are like commoditized by the big players, like I mentioned. But meme coins on Solana in January were very, very profitable. Not profitable in the sense of like buying and just holding and then selling, but like profitable in terms of like sniping. And a lot of the guys that I mentioned here, like Atomic Arbitrages and like Wintermute, for example, and like the DeFi guys at Wintermute, we have the capacity to implement this sniping at a very, very like low latency rate and essentially like beat the market. And yeah, if you basically sniped coins on Solana, you probably would have made like tens of $millions. Yeah, but like it just goes to show long tail opportunities, in my opinion, are the more interesting ones. But identifying these opportunities are always the hardest. It usually typically requires some like very niche signal that is like very difficult to come across, and you just have to find it by being in like the right chats or per se. But yeah, I'll leave it at that. Any other questions? Yeah. So I guess I can maybe say this. I don't think it like violates anything. But I worked a lot on like sniping stuff in January, but I wouldn't say it was the right time. But yeah, we did have some stuff running though. Any other questions? Yep. So this splitting would only occur in the RFQT model. And the RFQT model was the one where the taker has the ability to execute the trade. So it flips the like traditional RFQ model on its head, where usually it's the market maker that executes the trade. But in RFQT, the market maker basically says, hey, look, you take all of this information, like essentially all it needs is a signature from the market maker. Then the taker has the opportunity to like actually execute this and relay this on chain. So what I meant by like splitting this order amongst many market makers is, you can imagine, let's say there's 10 market makers and you split this order amongst all 10, like let's say there's a 1 mil order sell ETH and you ping each market maker for 100K. And this is the RFQT model, remember. So you aggregate all of their quotes and then you basically make a transaction on chain, which includes all of this data. And that's literally just how it's pretty trivial. Did that make sense or not quite? You can't split it with the RFQM model. It has to be the RFQT model. So it depends on the order type. If the order is partially fillable, then you don't have to send the entire order. But like, are you asking more like, is the market maker able to split the order in RFQM? As in me, if I'm like a taker, like if I'm not a market maker, from which perspective? So I want to like, I have like a $1 million order and I want to split it. Okay. So it's not necessarily the market maker that determines the model, it's the protocol that implements RFQ. So like an example of a protocol on chain that implements RFQ is Bebop. And so these Bebop has like, let's say 2 different API streams. One is for RFQT, one is for RFQM. If you want to split your order, you would only connect to market makers that are offering RFQT. It's not like a per market maker basis. It's more like the market maker opts in, and if they're opting in, then they're in the universe to split. Did that answer your question? I mean, we can talk about it after. I don't think I really understood what you were asking. Any other questions? Right. Should we wrap it up here then?